Ladies and gentlemen, what we're witnessing today in the global economy is deeply unsettling. The weaknesses we observe in several Asian currencies are not just random fluctuations in the forex market. It's the tip of a much larger, and much more dangerous, iceberg. We need to recognize that these currency movements reflect broader, systemic failures in international economic structures. At the helm of this currency volatility is the Trump dollar surge, flooding the world, exacerbated by protectionist economic policies and reckless trade confrontations which were inherited through his administration. But make no mistake, what we see isn't simply about Donald Trump or some erratic market dynamics. The failings we're experiencing are symptoms of much deeper, structural problems. This analysis will take us from surface-level observations to uncover the full scope of economic vulnerabilities shredding Asia's financial landscape, based on numerous interlinked factors: the U.S. dollar policy under Trump's legacy, inflation pressures, central bank interventions, and capital flows, all while considering where we go from here. You may remember that, during the Trump administration, economic policies aimed to reinforce a massive America First agenda. And if we're honest, it's having ripple effects 4, 5, 6 years later. Excessive tariffs, combined with a strong dollar policy and loose taxation strategies, were meant to make U.S. economic interests paramount. But what happens when the U.S. federal government prioritizes short-term inflationary policies while maintaining, or even increasing, tariffs? Global markets experience high inflation, and the tension is released in emerging markets primarily in Asia. Global capital shifts to the dollar, bad news for countries relying on dollar-sensitive export economies. In short, many Asian economies rely heavily on low-cost manufacturing, exports, and foreign direct investment, FDI. Trump-era tariffs, along with promises to bring back manufacturing to America, directly targeted Asian export powerhouses like China, South Korea, and India. For example, when the U.S. imposes tariffs on Chinese goods, the yuan weakens as China allows depreciation to offset the disadvantage tariffs bring. The question each country then faces is whether to defend their currency or capitulate to a weakening exchange rate, triggering reactions of capital flight and volatility in foreign exchange markets. And let's take a moment to zero in here. The Bloomberg Asia Dollar Index, a key indicator of the performance of Asian currencies, is now on track for its third straight monthly loss. The clear reason: traders are expecting even more future dollar strength fueled by these lingering policies. Hedge funds and larger asset managers have positioned themselves with a strong dollar bet that outpaces anything since May. So where does this leave the yuan, or the Korean won, or the Indian rupee? In a position of mounting pressure. Chinese yuan, for instance, hovers near a one-year low, and China's central bank can only afford to control the currency so much before it stretches beyond control. Similarly, the Korean won is the weakest Asian currency of the year, falling further after President Yoon's debacle, unable to dig out of its rut. As typically observed in global markets, Trump's tariffs effectively fanned the flames of inflationary trade wars that have continued even post-presidency. Investors are betting on more pain, pricing in future tariffs combined with entrenched inflation. They have one foot in speculative U.S. assets that benefit from a strong dollar and one foot out of the excessively debt-ridden, export-reliant economies. Current signals from the Commodity Futures Trading Commission also forecast exactly that, hedge funds positioning themselves with increasingly high levels of dollar carry trades while making Asian market participants brace for negative outcomes. Economies as dependent on exports as South Korea are taking the hardest hit since their industrial sectors are directly targeted by the tariff practices, and market sentiment moves accordingly. And let's not overlook Christopher Wong's warning from the Overseas Chinese Banking Corporation: the broader dollar-Asia trajectory, excluding Japan, is headed upward, meaning that the path of least resistance seems to be continued dollar gains. This is a structural problem now. Not just market perception or volatility, but underlying imbalances that leave little room for countries to respond. China's currency movements are illustrative of where broader economic risks lie. The onshore yuan, that is, China's domestic currency as opposed to the version traded outside its borders, is now staggeringly weak as it edges close, yet again, toward a 7.3 to the dollar threshold, which is just shy of an important psychological low. Why does this matter? Because, as we know from history, currency depreciation harms investor confidence, especially with trade-related frictions in the middle of the issue. A cheaper yuan might seem like a relatively good trade move for China amid tariff wars, but it comes at a cost. Investors increasingly bearish on the currency further fuel potential sell-offs, enhancing downward pressure, and trigger a surge in capital outflows. Witness the significant gap between the box-managed fixing and real market pricing, over 900 pips recently. The PBOC is now essentially playing a costly balancing game, striving to keep the yuan within a narrow band around 7.2 to the dollar in order to prevent disorderly market movements. It's like putting band-aids on a sinking ship and hoping the leaks stop. What is important to realize is that even though China may have allowed space for a weaker currency to pad its trade front against the US, the confidence in China's ability to stabilize its economy is faltering. China's growth is slowing down dramatically. Historically high levels of debt and an imploding property market aren't helping the scenario either. Shifting gears, let's focus on South Korea, whose currency has become Asia's biggest loser this year. At first glance, you could credit the political crisis under President Yoon Suk-yeol's failed term for weakening the won. But that is only part of the picture. The deeper issue relates both to ongoing news of U.S. tariffs spilling into global trade talks and threats against major Korean companies like Samsung and Hyundai. South Korea's export-heavy industries feel the pinch more than ever in the context of a strong dollar frenzy. The government's efforts to stabilize the won at this point are like trying to stop a dripping faucet after the pipes have already burst. While the $1 exchange rate reached an intraday high of 1,444.65 won per dollar, showing massive depreciation, authorities' heavy intervention is clearly overwhelmed by persistent inflows into safer dollar-denominated assets. Volatility warnings aren't going to save the situation when the broader macroeconomic picture pushes capital toward the U.S. In India, the Indian rupee similarly finds itself in an extremely vulnerable position. Despite a relatively controlled inflation environment currently, as India manages easing inflationary pressures, the real danger is how this relates to monetary policy expectations. Governor Sanjay Malhotra is expected by investors to possibly ease monetary policies further, weakening the rupee even more. Facing record lows already, any downward movement from here could be catastrophic. Already, the rupee plummeted past 85 against the dollar, signaling massive capital outflows might soon grow. This is only exacerbated when markets, spurred by recent signals, anticipate massive liquidity injections in the banking sector in conjunction with those rate cuts. But where one sector gains in liquidity in loans, picking up the slack in private investment, the rupee, through increased speculation, will lose global competitiveness, thereby raising India's dollar-denominated debt burden and worsening trade deficits. And when inflation picks up, as rate cut policies tend to induce, Malhotra's immunity from further pressure evaporates. Even the Indonesian rupiah, which has typically been regarded as relatively stable, is showing cracks. The currency recently slumped past the crucial 16,000 per dollar level, often a psychological breaking point for market confidence, and could decline further toward 16,325 depending on external dollar movements. This latest development arrives despite Bank Indonesia's emergency interventions described as bold, a clear attempt by the central bank to shore up the currency by defending it with its depleted reserves. Experts expect interest rates will remain steady in the next policy meeting, and this will tell global financial markets that Indonesia, too, recognizes the battle of currency depreciation. The combination of dollar resilience and tariff-related pressure keeps Indonesia without the export strength it once showcased, potentially tipping it toward more rapid devaluation by 2024. Compared to its fellow Asian currencies, the Malaysian ringgit has performed admirably in 2023 so far. It gained by about 3%, partially due to the central bank's push toward economic reform and the repatriation of profits back to the country. But we should exercise caution in painting too rosy a picture here. Even with Malaysia's improving economic outlook, concerns about U.S. tariffs still present downside risks. Indeed, while the ringgit's edge was above 11% earlier in the year, the narrowing gains reflect investor fears that Malaysian industries, especially in electronics and palm oil, might take a hit if U.S. tariffs expand into newer sectors or place restrictions on key Malaysian exports. The reality is that Malaysia's gains could be curtailed unless there's a fundamental shift in trade dynamics. Furthermore, if the US dollar continues to strengthen, even the relatively resilient ringgit could come under pressure as global investors move assets towards seemingly safer, higher-yielding US securities, reducing the appeal of Malaysian assets. We've talked about individual currencies, but let's zoom out and look at what's truly happening on a macro level. At its heart, the weakness in Asian currencies underscores a larger problem of global imbalances. When the US dollar strengthens, which it has consistently due to a blend of soaring inflation, aggressive monetary policy posture, and tariff concern-driven demand, it immediately triggers vulnerabilities in emerging markets. For many of these Asian economies, whether Malaysia, Indonesia, or China, their currencies are directly tied to their export economies. And when the US dollar strengthens, it makes their exports more expensive on the world stage, reducing demand and further exacerbating trade deficits. Moreover, high U.S. interest rates, which have barely started their decline after a prolonged aggressive hiking cycle, are continuing to attract global investors, leaving emerging market assets with diminished appeal. This sets off a vicious cycle of capital outflows from Asian markets, leading to a self-fulfilling prophecy of even more pressure on their currencies. Add to that the Trump administration's legacy of protectionist tariffs and trade wars, which ignited a geopolitical and economic time bomb in key export-oriented Asian economies, and we can see just how hard these countries are still working to recover their markets, manage inflation, preserve capital flows, and stabilize their currencies. The key takeaway here is that many Asian economies remain inextricably linked to the health of the US dollar. And as long as the US continues to pursue strategies that strengthen the dollar, and they will, particularly with ongoing inflation concerns and a global flight to safety. The downside risks to Asian currencies will persist, potentially pushing some of these economies toward crisis-level conditions. What does all this mean for global markets moving forward? First, the risks of contagion, financial instability spreading from one economy to the next, are growing more concerning. When we look at global capital flows, the majority of investment capital is concentrated in developed markets, particularly the United States and Europe. But the strategies pursued by the US, namely higher tariffs and strong dollar policies, could trigger broader instability in emerging markets. If currency depreciation trends intensify further, we may witness significant debt defaults from Asian countries heavily reliant on dollar-denominated debt. A collapse in local currency values could make it nearly impossible for these economies to service their external obligations, triggering waves of sovereign debt crises. Look no further than the 1997 Asian financial crisis for a parallel. Back then, speculative attacks on currencies like the Thai baht catalyzed economic collapses across Southeast Asia. Today, similar conditions are emerging, weakening currencies, external debt pressures, and declining export competitiveness. While governments and central banks are better equipped this time around, due to higher foreign exchange reserves and more sophisticated debt management strategies, the return of an Asian crisis scenario cannot be ruled out. Let's not overlook the second-order effects. As these currencies weaken, governments may feel forced to intervene more aggressively, whether through capital controls or higher interest rates, to stanch the bleeding. But such actions often create distortions in capital markets, leading to a loss of confidence and further reinforcing a negative cycle. Most Asian economies, such as China, India, and South Korea, rely heavily on exports to fuel their economic engines. With protectionism rising, tariffs increasing, and the US dollar at a multi-year high, these export-driven economies are becoming collateral damage in the global currency war. The constant downward pressure on their currencies, compounded by weak demand from their key markets, the US and Europe, especially, leaves little room for growth and recovery. China, for example, has already started feeling the pinch. Manufacturing output, a critical part of its GDP, has slowed, with many factories scaling back production. The continued weakness in the yuan exacerbates the situation by increasing production costs for imported goods and materials, further squeezing profit margins. India's economy, while more diversified, is also tethered to its exports of IT services and textiles. The weakening rupee, combined with slowing global demand, presents a serious challenge to maintaining growth momentum. At the same time, India's widening trade deficit is putting pressure on the central bank to maintain fiscal prudence while avoiding significant external borrowing, yet another tightrope to walk. South Korea, an export behemoth in industries like electronics and automobiles, finds itself at the mercy of American trade policies. With the yuan weakening amidst political and trade turmoil, South Korean businesses could see their access to global markets constrained as they face both supply chain disruptions and lower profitability. The implication is severe. If Asian economies can't revive their export markets or find ways to compensate for this dollar-driven squeeze, they face the prospect of reduced economic growth, rising unemployment, and potential political instability. In an ideal world, governments might seek out a coordinated policy response to address the underlying causes of currency weakness and trade imbalances. The International Monetary Fund, IMF, and the World Bank could broker agreements between major economic players, including the US, to relax tariffs and stabilize global trade relations. Central banks could coordinate efforts to unwind the US dollar's supremacy by working towards solutions such as creating currency swap lines or even promoting regional currencies. However, the realpolitik of today makes such cooperation difficult. The US, now in a competitive stance with China and distrustful of multilateral institutions, seems more focused on securing individual trade deals and maximizing its economic benefit, regardless of the impact on emerging markets. Moreover, China, which could provide a counterbalance, is pursuing its own Belt and Road Initiative, focusing on extending its influence rather than stabilizing currency markets. At this point, barring any significant global policy shifts, it's difficult to see a clear path forward for Asian currencies. The forces that weaken them, US dollar dominance, tariff pressures, decelerating export growth, and slowing foreign direct investment inflows, remain in play and show little signs of reversing soon. For professionals working in finance, the key takeaway would be to prepare for sustained volatility. The ongoing currency debasement, trade conflicts, and monetary policy divergences present increasing risks for investment portfolios. Careful management of currency exposures and close monitoring of central bank actions will be crucial. For ordinary investors, it may be more advisable to adopt a wait-and-see approach. The hunt for yield in other regions could make Asian investments seem risky for the near future, particularly in debt and equity markets dominated by export-oriented companies. What we need to brace ourselves for is a future where US economic policies play an even more outsized role in determining Asia's financial conditions. As the US dollar climbs, Asian currencies may continue to spiral downward, opening up long-term economic risks that no amount of central bank intervention or tariff negotiation can easily fix. To summarize, the weakness in Asian currencies, dragged down by Trump-era fiscal legacies and stoked by inflationary tariffs, endures primarily due to speculative market pressures on the US dollar. As we move forward into 2024, we should be prepared for further economic disruptions in Asia, whether through currency collapses or trade-related recessions. The sequence of events stretching from dollar overvaluation to unstable trade conditions has endangered the economic outlook for much of Asia. Currency volatility is no longer a short-term play but instead speaks to systemic issues that won't go away until there's a rethink in global economic leadership. And on the horizon, we should anticipate tougher times ahead for global markets, with Asia being the first, and possibly hardest, hit. It's a classic episode of greed in high places and government mismanagement, inflating the fortunes of a few, while pushing millions on the periphery toward the inevitable clutches of financial instability. Until there is a fundamental shift in approach, one that favors cooperation over conflict, stability over short-sighted policy goals, we should all take notice because this storm's just getting started. Watch this space closely, both finance professionals and everyday investors. Currency vulnerabilities in Asia aren't going away, and where the dollar moves, the emerging market will follow, often to their detriment. Is this a wake-up call for unilateral policymakers? Absolutely.